Hello, this is Rochelle Agatha, and this lecture is on the adjusting process, which is going to take you beyond the intro to accounting and analyzing transactions. Now we're actually going to talk about what we do to adjust certain accounts. After studying this chapter, you should be able to describe the nature of the adjusting process, journalize entries for accounts requiring adjustment, summarize the adjustment process, and prepare an adjusted trial balance. So if you recall, up to this point we learned how to do some journal entries and get a basic trial balance. Now we're going to move beyond that and learn how to adjust. The first objective is to describe the nature of the adjusting process. Under the accrual basis of accounting, which you're all familiar with at this point, that we don't use cash basis of accounting, we use accrual basis. Revenues are reported in the income statement in the period in which they are earned. It has nothing to do with when you get the cash. So if you perform a service, you're, say, a cleaning company, you go clean for people, they pay you later, you get the revenue at the time that you did the service. The accounting concept that supports the approach to reporting of revenues is called the revenue recognition concept. And what that says is that revenue is recognized when it's earned. It has nothing to do with when it is received. The journal entries that bring the accounts up to date at the end of an accounting period are called adjusting entries. So you'll go through the month and you'll write checks and you'll receive cash, and a lot of cash stuff will happen. And then at the end of the month or the end of the period, you need to adjust certain accounts. Accounts that are typically adjusted include supplies, prepaids, things that you pay in advance, that's a prepaid. Insurance, a lot of times you pay for an insurance policy up front. Wages, depreciation, and unearned rent. So these are the basic accounts we're going to learn how to adjust. Prepaid expenses, or also deferred expenses, are items that have been recorded as assets. So cash is paid in advance is the other way to look at it. Expenses are recorded when they are incurred. That's accrual basis accounting. Unearned revenues or deferred revenues are items that have been initially recorded as liabilities. So this is where cash is received in advance, but revenue is not yet earned and the service is not yet performed. So somebody gives you money in advance and you haven't done anything for it. That's an unearned revenue. Revenue is recorded when earned, when the service is performed. So keep both that in mind. In both instances, when you got the cash did not drive the revenue, and when you paid the cash did not drive the expense. What drives the recording of an expense is when you incur it, and what drives the recording of revenue is when you perform the service. Accrued revenues, sometimes referred to as accrued assets, accrued means unpaid, are revenues that have been earned but have not yet been recorded in the accounts. Accrued expenses, sometimes referred to as accrued liabilities, are expenses that have been incurred but have not yet been recorded in the accounts. Another way to look at it is physical resources that are owned and used by a business and are permanent or have a long life are called fixed assets or plant assets. So those are things like equipment or trucks or buildings. As time passes, a fixed asset loses its ability to provide useful services. So this decrease in usefulness is called depreciation. So when you buy a truck, it goes on your books as an asset, and then as you use it, you expense it over time, and that expense is called depreciation. Fixed asset accounts, also known as property, plant, and equipment, have a normal debit balance: equipment, land, and buildings. Accumulated depreciation is a contra asset account. It has a normal credit balance, where it is where depreciation expense is accumulated as it is recognized. Okay, so the second objective is, what do you do with all this information? Okay, I realize I have some accounts where I pay for things in advance, and I have some accounts where people pay me for things in advance, and then I got these assets. All of this stuff is what you're going to journalize at the end of a period and in this adjusting process. So let's do supplies first. The supply account had a beginning balance of $1,000 $245 and was debited for $28.60 for supplies purchased during the year. This is a very typical transaction. Assume that at the end of the year, the balance on hand is $13.49. So I'm going to show it to you two ways. So the entry that you're going to book to supply expense and supplies is what was actually used. So you're going to take the $12.45 plus what you bought of $28.60 less what's left on the books, and that amount is $27.56. So let me show it to you in a T account. Here's our T account where you have the $12.45 and the beginning balance plus what you bought of $28.60 less down here, I don't want to make you dizzy, but the $13.49 is the ending balance. So the difference of what you used is the $27.56. And notice that there's a debit to the expense and a credit to the asset because you're bringing the asset down to what's left on the shelf, basically. Okay, let's do a prepaid. Same kind of thing. The prepaid account had a beginning balance of $4,800 and was debited for $58.50 for premiums paid during the year. Here we're talking about prepaid insurance. Assume that the amount of unexpired insurance for future periods is $41.25. So here's our $4,800 plus our new paid amount of $58.50 less what's left for future periods. So this example would be like you have an annual auto policy and it goes, say, from September 1 to August 31. So you know you pay the whole year up front and then you have to expense the part that is used on a regular basis. Looking at it in a T account, the same kind of thing. There's your beginning balance of $4,800 plus another year that you paid for, and they're telling you at the end of this reporting period there's $41.25 left. The difference, the $65.25, is what was used, so that's your expense. So I think it makes sense to use the T accounts, and this is where I want to show you. Some people are really good at journal entries like this. Others, it makes more sense to draw a T account, and I suggest as you're learning to do the T accounts. Now let's walk through the unearned fees adjustment. Unearned fees had a balance before adjustment of $23,676. So these are fees that people paid you for in advance and you haven't done the service yet. Then assume that you were, at the end of the year, the unearned fees were $73.88. So what you earned, notice that you're debiting unearned fees and crediting fees earned, is the difference between the two. So once again, in the T account, you had a beginning balance of $23,676. They told you at the end it was $73.88. The debit to the liability account is $16,288, and the credit to the revenue of fees earned is the same amount. Unearned rent is where you Smith Company received $1,600 for 12 months of rent, and they want you to journalize the entry at the end of the year. So you earned 5 months of rent. So $6,900 divided by 12 times 5 months is what you earned. Once again, on the T account, there's your, this one has 3 accounts related. Here's your original cash receipt of the $6,900, the debit and the credit. And then they tell you at the end of the period you have $4,025 left, so you earned the $28.75. So you had 3 accounts in this set of transactions, the adjusting entry being the $28.75. And one more, the depreciation expense. The estimate for depreciation on equipment for the current year is $18.20. In the early chapters, they give you this information, and not until you get to the fixed asset chapter down in chapter 10 do you actually have to figure out how to get this. So right now they're telling you that you had $18.20. So you hit depreciation expense for $18.20 as a debit, and you credit. Remember that contra account we mentioned earlier? Accumulated depreciation is a contra asset account. And if you look at it on a T account basis, here's your entry here. Debit to expense, credit to accumulated depreciation. After you do all these adjustments, and I'll just back up because I realize this is fast. I try not to make my talking lectures too long, just because they do take up a decent amount of space and for you to pull down. But up until this point, I gave you an example of the basic adjusting entries that you learn in this class. There are a whole lot of other types of accounts that you adjust, and you will even see some of the payroll accounts out there. Just keep in mind, you're going to adjust anything that at the end of a given period, the account is not reflective of the true revenue or expense. So it's been like a cash basis, and now you need to get it into the accrual basis. Okay, objective 4 is to prepare an adjusted trial balance. So once you're all done, the purpose of the adjusted trial balance is to verify the equality of the total debit balances and the total credit balances before the financial statements are prepared. So here's the accounting cycle. The transactions are analyzed and recorded in the journal. You want to post the transactions from the journal to the general ledger. You're going to prepare the unadjusted trial balance. So this is kind of where we've been through this. Then there's adjustment data is gathered and analyzed, which is what we just covered. Then there is an optional end of period worksheet. Then you record your adjusting entries. Prepare the adjusted trial balance. So that's where we are right now. Then you prepare your financial statements, and then you record your closing entries and prepare a post-closing trial balance. So that's all of your steps in your accounting cycle. So at this point, I just want to say that you got through the adjusting process, and if that was a little quick for you, go back and make sure you've read the chapter, and then come back and listen to the lecture again if you need to, and you can look at the slides individually, and hopefully that'll get you through. If not, send me an email and I will help you.